The Barr resignation?
Yeah, if he was comfortable with the new administration, he probably wouldn't resign, what, a year and a half early or something like that?
Yeah, no, he clearly, I mean, Trump has criticized Barr for a long time, and he just didn't want to be in a legal battle for his position. Plus, in my mind, there was no upside for him staying there because if Trump does pursue his deregulatory efforts in the banking system, and then you have a financial accident down the road,
Yeah.
Barr is going to be blamed for the lax oversight. On the other hand, if the deregulation leads to stronger growth and good things for the banking system, Trump's policies are going to take credit. So it was a no-win situation for Barr to stay on.
Yeah.
And
the guy obviously doesn't need to work, so why put up with the hassle?
yeah, and he'll stay on as a governor. He just won't be head of supervision. So
But
the
that means
interesting
that
thing,
Trump nominates and the Senate confirms the follow-on person. Is that how it works?
that is correct. It requires a Senate confirmation. And we were talking to our contacts in Congress yesterday. It's interesting, this guy, and I can't pronounce his name, Huitema, Huitema. He was appointed in November as head of the Government of Ethics, Office of Ethics. And he's been slow. So in order to get a vice chair appointed, there's certain paperwork that has to be filed. And that's true for a lot of very senior appointees. And this guy was put in place by Biden to slow down all the appointee processes. And so he's slowing down everything through paperwork. And so it'll be very hard for Trump to get his appointees in place before he takes over on January 20th.
Aha. Yeah, interesting.
And that is a very, significant, process that Biden clearly wanted to put in place to prevent, certain appointees occurring before the inauguration. I mean, this guy, who's heading up the Government Office of Ethics, presumably will be fired on January 20th as soon as Trump is inaugurated. But
I did not know that was a. That's interesting.
Yeah, it's throwing sand in the gears of trying to get things jump started under Trump.
So it's called the Office of Ethics.
Yeah, government ethics, OGE, Office of Government, OGE, and the guy who was appointed in November is Huitema. I don't know how you pronounce it, Huitema. And
so it's not Doge. It's OGE.
Yeah, OGE. Without the D.
The Department of Government Ethics, it would be Doge.
Yeah. Anyway, this whole, political machination is fascinating in terms of what, each party is trying to do to off balance the other party. But the resignation of Barr is interesting because it does sort of say the engines of deregulation have started in banking anyway. But it also raises the question of how much interference is Trump going to impose on the Fed's policies, and that's dangerous because if the Fed starts to lose credibility because of Trump pressures, then our bond market could get very much out of hand. And that to me is the biggest risk right now is what's happening to our bond yields. And I wrote, at Portalis back in December that, we face the Liz Truss moment sometime in the first half of this year.
Interesting.
So,
all right, we got half a minute.
I would say that, right now deregulation is driving bank stocks higher, and rightfully so. I think over a multi-year period that's going to happen. But in the short term, rates could override deregulation, and that's what makes it tricky. That this excitement around bank stocks and what they could do over a multi-year period versus short term.
Interesting. All right, guys, let's get started. Hey, everybody, I'm Paul Meeks. Welcome back to the crew at Wall Street Beats. Happy New Year to all of you. Today is January 7, 2025, and if you followed the markets last night, you know that we just live in Jensen Huang's world. We'll see what happens. So today we have a great panel. We have Charlie Peabody, who's going to be leading off, followed by Berna Barchet, and then Ben Bry. So Charlie, let's get at it.
All right. So I'm going to today preview some of the fourth quarter bank earnings. The banks are the first, industry to, start off earnings season, and the major banks start reporting on the 15th of January of next week. So I just thought I would start off by, showing some of my expectations versus street consensus. So Jen, if you could put up the first chart on earnings. So on the left-hand column, you can see my estimates, and then in the column right next to it to the right are consensus earnings estimates. And the first observation I would make is, for the regional banks, we're looking at, mid to, high single-digit type of growth rates. And for the capital markets banks, you're looking at double-digit, robust growth rates. Where I differ from the street the most is with Citigroup. I'm looking for $1.46 of core earnings. It could be $1.35 reported because they have some restructuring charges they may, take in the quarter. The street's at $1.23, so I'm way above the street. But Citi, has been my number one pick last year and continues to be my number one pick this year. It way outperformed the S&P 500. Was up mid 35% versus 23% for the S&P last year. So it was a good stock to own. I think people continue to underestimate the excess capital that they're going to generate going forward, and the ability to buy back stock at deep discounts to tangible book value. I think people also underestimate the progress they're going to make on the expense side. This is a company that for the last decade has failed at meeting its target goals. So there's a lot of skepticism still around this. But I think Jane Fraser is the real deal and is going to turn this company around. Short term, I think the big surprise in the fourth quarter and why I'm a little more bullish than the street is I think revenues are going to prove to be better than expected. And people will pay for revenue growth. So I like the idea that Citi has further upside. We will see revenues for this industry growing at roughly a 4% mid-single digit rate in the fourth quarter. For the capital markets banks will be a double-digit rate because we're having very robust investment banking and trading revenues. The one observation I would make about the fourth quarter revenues versus 25 expectations, and I don't show my 25 expectations on this chart, but for the fourth quarter, as I said, revenues are expected to grow mid-single digits. Right now, for the 25 revenue expectations, the street out there is expecting low to mid-single digits. And if Trump is successful in his deregulatory efforts, his pro-growth policies, we're going to see revenue expectations for 25 for the banking industry, to tick up. So banks, are emerging as a good place to be invested. The names I like are Citigroup is my number one pick. M&T Bank, which I don't show here, is a name I've used in the past, and Citizens Financial CFG is another one. So those are the ones I've been highlighting. Truist, if you're into total return, they have a very high dividend yield. They're a turnaround candidate. It's a show me stock at this point, but Truist is another one that if you're looking for total return, I think is an interesting turnaround candidate. So those are the four names I've been using.
It shows on your chart the biggest year-to-year shrinkage in revenue at down 12%.
At Truist, yeah. They're going to have a tough fourth quarter, partly because they sold their insurance, their property and casualty insurance operation. So the comparisons are really not apples to apples. They had to sell that insurance operation to raise capital to fill a hole in their balance sheet from the unrealized losses in their bond portfolio. But they've done that. They now have excess capital. They just started buying back stock in the third quarter, and they will continue to start buying back stock. And the rest of the operation, the core banking operation, is starting to improve as well. So it is a turnaround situation. Don't be misled by the down 12% because it's not really an apples to apples comparison.
Sure.
The last thing I'll say, and then I'll turn it over to Berna, is tomorrow Jefferies reports their fourth quarter earnings. Jefferies' fourth quarter ended November 30th. The reason I mentioned Jefferies is they're a big capital markets shop with a lot of trading, a lot of merchant banking, a lot of investment banking. Um, and people use their report as a preview as to what the big capital markets banks are going to report next week. And the difference is that Jefferies' quarter ends on November 30th, so it does not include the December month in their earnings. But it gives you a sense, you have 2 months, October and November, of activity, it gives you a sense of what to expect when the big banks report next week. And it's my expectation that capital markets revenues will be very, very robust. You can see on the bottom rung there, the investment banking revenues, and I have them up, anywhere from 25 to 45%, with J.P. Morgan showing the most robust growth year over year in investment banking. We are seeing a comeback in M&A and IPOs, which is adding to the already strong debt underwriting. So that's going to help investment banking, particularly the M&A side. On the trading front, again, it's going to be all over the lot, but generally we're looking at anywhere from 10 to 20% year-over-year growth, with Goldman showing the most robust. But that's because their fourth quarter last year was depressed, so I would not take that growth rate and extrapolate it. So we're going to have very robust capital markets, which is why my estimates for the big banks like Bank of America, Wells Fargo, Citi, JP Morgan are above the street. I'm expecting those capital markets to be robust. So why don't I turn it over to Berna if there's no questions?
Yeah, Berna, tell us a little bit about Alico.
Yeah, this is one that people probably haven't heard of because it's a 200 million market cap stock with exactly one analyst following it. So a little bit off the beaten path. This company is currently, but not for much longer, going to be the second largest citrus grower in Florida. So this company has been around for over 100 years, has over 50,000 acres of orchards in Florida. And I've known about the company for several years, been involved with it. I bought it last year, sort of under. I was getting. There's always been a hidden asset value to this company because a lot of this real estate, the best use is no longer growing oranges. I think we all know how many people have moved to Florida, how much the state's population has grown, and how much suburban creep there has been. So some of the land, including orchards that I visited in 2022, are bumping up against fast growing suburban areas like Fort Myers. So I always thought there was a path to monetization of land that would be better off becoming housing developments versus or other commercial purposes other than growing oranges. And yesterday, the company dropped a bomb saying, we're throwing in the towel on the orange business after 125 years. So you can look, the stock was up 19% yesterday on 65 times normal volume. 40% of the float turned over yesterday. Because I think there are a lot of sort of deep value, asset driven investors out there who traffic in these kind of stocks who have heard about this idea, but it was kind of an idea with no catalyst. So their plan is oranges, get harvested in the spring. And so they're running through this next season, the 24-25 season, harvesting it, selling it all to Tropicana as they always do. And then they're not putting any more resources in this. And so about 10% of the land is monetizable now. I know from talking to the company that there are home builders, both public and private, who have been snooping around this land for a long time. That land's going to go into immediate fast track sale, hopefully to be monetized within the next 5 years. There's another 15% that's sort of behind that they're looking to sell in the intermediate term, which I assume is, more than the next year or two, but less than 10 years, right? And then the other 75% they think remains agricultural land, but it's going to go to different crops, which they didn't specify. And I'm not sure if they're going to be the ones to farm it. So when you put it all together, they have a 650 to 750 million dollar estimate of what their land is worth. I had done this on my own a couple of years ago and kind of came up with a wider band of 500 to 750. But either way, it sort of lands, in that 600, 650 midpoint. And if you assume full capital gains taxes, and there may be some avoidance that they can do here on a full 20% rate, but assuming a zero basis and 20% taxes, sort of the most conservative assumptions, there's 100% upside as they wind down this company. Now that sounds like super sexy, but it's really not, because it's probably going to take them 5 years, right? And so that works out to like a mid-teens IRR if you were to hold. Now, do I think the stock will be up 15% a year for 5 years, the next 5 years? No, I think, they'll announce a land sale. It'll go up, 25% or whatever corroborates with the immediate value, maybe a little bit more, because the discount to the NAV gets eroded with each, sale they make, gives them some credibility. But you're not going to get that whole 100% quickly. But I think what's really interesting here is that it's a completely uncorrelated play to financial markets. Now, it might correlate to Florida real estate, and I know that Charlie has had feelings about home builders and Florida real estate and all that. But you're talking about zero cost basis land, so I don't think they're making heroic assumptions, and I think the longer term patterns of people migrating to Florida, are still intact. So, I think this is interesting. I think that this is a nice diversifier in the portfolio, something that is not going to swing around with whatever NVIDIA says, completely, not a bond because it's not cash producing, but uncorrelated. This is more like investing in real estate at this point. And I really like the CEO. That was part of what attracted me to this. He's a smart guy who came from banking and finance. So I like this here. I think the other thing that is worth mentioning here, these guys have been trying to make the orange business work. And the reason it has stopped working is because we've had 3 catastrophic hurricanes in the last 7 years in Florida, the most recent being Milton. And also there's this disease called citrus greening disease, which has reduces the output on healthy trees, and in the worst case scenarios kills the trees. And it's a problem in Florida, it's a problem in Asia, it's a problem in Brazil. It's something that emerged out of nowhere, probably due to higher temperatures. So if these guys can't make oranges work in Florida, and they're the second biggest company, and they had been pouring resources into, I think they planted 2 million trees in the last 7 years, trying to replace the trees that had died from the greening. They were, at the forefront of using a new emerging medical tool to sort of reverse and treat greening. And it still they couldn't get to an acceptable return on investment, given all the planting and all the treatments they needed to do. It's weird to think, for those of us who grew up with all those Florida orange commercials, that, you're not going to see citrus grown in Florida anymore. But I think it's just a cautionary tale for ag businesses, and something you really have to look at. Here's a business that did a good cash flow for like 115 years, growing oranges, and now they can't make it work anymore. And they have sort of break glass, take parachute option, because their real estate is adjacent to major metro areas, and really, a lot of it is really valuable. But a lot of places that are in the farming business are not adjacent to cities. So I think it's a cautionary tale that if you are investing in any ag businesses around the world, you really need to think about are the next, 10 or 50 years going to look like the last 10 or 50 years? And in a lot of cases, the answer is going to be no. So that is it. I think the fact, though, that they're so abruptly throwing the towel in on the orange business after spending all these years trying to make it work, through the hurricanes, through a freeze, through the greening, indicates that maybe they've got some offers on the table, and maybe the first land package sale might be, quick, because the abruptness of this makes me think that maybe there's a burn in hand, but that's complete conjecture on my part.
Hey, Berna, I
No,
have a single question, which is 75% of the land goes from citrus to other ag for it to be monetized. Is that right?
Yeah. Well, yeah, but
And
that's the smallest piece of the DCF.
okay, because I was
Yeah,
going to
that,
say,
that's
who's to say that
it's
anything could be thrown there?
this is one of these things where 80% of the value is in the top 20% of the land.
Understood. Understood. Charlie,
no,
did you have a question?
Bernard, yeah, I did have a question and observation. First of all, I do think land will hold its value much better than the structure on the land. So I think in that sense, your recommendation is solid. The other thing I would suggest, Lennar, the home builders are trying to get out of the land business because of the high cost to carry, I guess. And Lennar is in the process of trying to spin off their land holdings. And so that might be a transaction worth looking at to see how land is being valued.
Yeah, definitely.
Interesting. Hey, Benjamin, what do you have for me today, brother?
Okay, so I'm going to update a few longs that I had put on the show. If you guys go back to late October, early November, I had told people to buy Boeing when Boeing did the $22 billion capital raise, one of the larger equity raises. And, Boeing's one of the great American companies, and it's obviously had a rough run of it. But that was heavily anticipated. And if you didn't want to own Boeing, by that point, the shareholder base turned over, right? And they recapitalized their balance sheet. And as I said, I have a lot of special situations background. That was a good time to buy. And so since then, it's gone up 30-some%. And I punted my stock. I haven't been a contributor. So I mentioned it yesterday as a moderator, but I just thought I'd talk about it a little bit more since I put it on at the end of the year at like 177, 178, December 31st. It is what it is. It's dramatically outperformed all the defensive stocks. I don't know if you guys pay attention, but Lockheed, we were talking about it this morning, Nadine and I, is at a 22 RSI. Okay, like it's more oversold than it was in COVID. And that actually goes along with the defensive names as well, Pepsi and Church and Dwight and PG. So, all these charts basically peaked in late September, early October, and then that's right when the Trump surge started, and then obviously Trump won. So I think defensive stocks and defense stocks, D&D, if you will, both are fully pricing Trump, and now we got to see what it is. But I think it's one of those situations where just a little less bad, and these stocks can do better. But I don't know, Boeing seems to have dramatically outperformed after underperforming for a while. So I'm just going to take my profits and roll. They still have a lot of issues. The other one that I trimmed half of yesterday was Joby Aviation, which is the flying taxi company. Again, they did a deal in early November at $5 or $5.05 actually. And this morning it was at $10.70. And then it actually got sold pretty good as the market's selling off here this morning. And I usually look for those kind of candles as where's the supply? And it feels like above $10 here at $10, there's a decent amount of supply. Now I'm going to keep half of it because we had interviewed the head of engineering at that firm on our podcast. And I was like, you know what? This is a $3 billion company that could be a $100 billion company. I do a terrible job. Just so everyone knows, I bought Bitcoin for the first time at $150 and I'm not worth 9 figures. So, the holding part of the trade identification isn't my problem. It's the holding problem. And so I think that the Joby seems like a very interesting thing with a lot of smart guys. So I'm going to keep half of that for a long-term trade. But the trade part of it, I think, look, it's 100%, it's up 100% in 2 months, so those were both kind of special situation oriented trades. Turnaround for Boeing, Joby's just, an early, like basically a public like, it should be private, but it came public during that SPAC time. So, and then in terms of one other long, and Charlie and I have talked about this, and I've talked about it a lot, is SJB, which is a way that you can get, it's like a cash plus option against the market, which it owns CDS on high yield, and then invests and it owns T-bills, right? So it has a swap, and then it has T-bills, and the T-bills obviously are earning 4.25, and the distributions have been quite good. They just paid a 34-cent distribution in December. This is $16.10 stock. And then that was a quarterly, and now it's a variable distribution. They're giving you the refund for owning the T-bills. But I think it's a great time to be long something like this as a cash substitute. You can get the T-bills, plus you get the free option against the market, against your longs with credit spread. High yield credit spreads are at 300, IGs at 48 basis points. Credit spreads are extremely tight. One of the reasons for that is that the absolute return is pretty good because interest rates, the curve is pretty high. So when guys see, oh, hey, the 5 years at 440 and I'm getting 300 basis points on that, there's a lot of guys who have a mandate to buy credit, and they're like 770 is a decent total return, total yield. And so, but again, my view is that we will see the short end come down over this year, and I think 2% is totally in play by the end of the year, and the market's not pricing that at all, and so then what you get is you would get the curve to steepen quite a bit, because I'm with Charlie that I don't see the long end coming in a ton. And as Charlie said, in all his banking days, he used to have the 3-6 dynamic of borrow at 3 on the short and lend at 6 on the long. So historically, over time, you see the term premium or the term spread, like the 10-2 is kind of the most famous one, but I like to do the 5-3 month. But point is, there's going to be term spread, which is good for banks. It gives them ability to do carry trading. And they can be the guys who buy the treasuries if they want to term out the treasuries. But one of the things that's happened and well discussed is that the treasury changed its duration profile quite dramatically over the last year and a half, 2 years, with issuance of bills becoming much, much higher percentage of total. And so it brought the average duration of the treasury portfolio down about 1.3 years, 1.25 years, something like that. Which then dramatically helps asset prices. So, if they are, Basantis kind of said that he's not really on board with that. And so if that mix changes to more terms, and then we have economic weakness, and it doesn't even have to be economic weakness. I think if you look around the world, and this is what I'm going to talk about last, the rest of the world's kind of terrible shape. Like Europe's a disaster. China is an outright disaster. Like, I don't know if you guys have paid attention to the Chinese bond market, but it's literally like ripping. Like, and by ripping, I mean the yields are falling like a rock. Like, I think it got down to a 1.5 handle briefly there in the last week or so. And so, then they offer $500 billion, $400 billion of treasuries. But the whole point is that I think the rest of the world will suck down the dollar, or will suck down the U.S. And if the Fed doesn't cut, then the dollar is just going to be the what steamrolls everything. And so the dollar will do the job and I think that initially Trump and these guys want a strong dollar because that makes China come to the table. And there's a lot of dynamics that I don't need to go into here completely, but basically they're trying to protect the currency, and that's causing all kinds of problems. And they need a weaker currency. And so it's just a matter of time until there's some kind of grand deal that's probably struck between the U.S. and China. But I would expect like closer to an 8, maybe higher RMB. But the one other floating peg that sits out there is the Indian rupee. And last July, I had talked about owning convexity on the Indian rupee, like owning 10 Delta butterflies. And those are starting to work a little bit. And I also am short the INDA, which is what I was going to talk about today. Now, this chart looks bad, and it looks like it's going to get a lot worse. It's about 5270, 5280, but it literally just looks like it's ready to take one of those like huge red candles down. And India, and by the way, that ETF is about 27% banks. And, you know, they have a couple, and then consumer discretionary, and then some tech. But India is a mess, and that currency is still overvalued. They're going to have to raise rates to try and protect it. But I just think that if they raise rates, then it's going to smoke the equity market. So, you know, I own both the vol on the currency and then shorting the equity. And I think it's just like emerging markets in general. I mean, look at Brazil, right? Like Brazil's a disaster. And you know, Mexico's been, after being the darling of all, like, you know, the Mexican peso was just the dominant trade for a while. You know, that's kind of gone the other way. So for now, I think emerging markets are weak, and that's been a huge, huge, huge market, right? Like as the people, you know, the Pan-Asian funds that are based out of Singapore and Hong Kong and maybe Tokyo, you know, money went into Japan, their market did quite well, but a lot went into India. And because China's been a no-go for their equity market for years now, right? Like multiple years, the Chinese market's been nothing. You know, I had a trade last year that was good, but that was from absolutely depressed levels. And then when everybody was excited, Tepper's going on TV being like, you got to buy China. Well, what's it done since then? When I sold them my stock, you know, it's like back to just wallowing, you know, like that economy's can't look, there's $18 trillion of losses in the real estate market. They're in what you call a true debt deflationary cycle, right? Or spiral right now. And they're going to have to try to arrest it. I mean, they don't have to, but that's what governments tend to do. And so I like India short, and the INDA, I don't have any like specific, you know, names. This is more of a macro thing, but like that's a weak chart that looks like it's going to get weaker. And so, yeah, that's kind of where I'm at.
Hey,
Well,
hey
there's
Ben.
been a lot of pessimism on the optimistic side. Since I live in Charleston, South Carolina, you know, we build the Dreamliner 787 for Boeing right down the street. So
Oh, all right.
hopefully that one turns around.
Yeah,
Anybody
I mean,
else have any comments?
Well, I'll just-
Ben,
Go ahead.
you know, your comment on SJB really is, I'm all in on that. You know, I'm going to preview sort of the credit trends in the banking industry on early next week on the show, but and I expect the banks will be very constructive on credit quality because the problems really exist outside of the banking system. That's where market share has been taken, and that's where risk has been taken. And so I think if I had to buy one thing and hold it for the calendar year of 25, it would be something that benefits from a spread widening trade because I think credit is going to be problematic next year. So I like SJB. But do you know what's in there? Is it private credit or is it bank loans or bank?
No, it's HYG or HY43 CDX swaps, credit default swaps, and then they have some HYG swaps with Goldman as well. And just so everyone knows that, like, we're creating a product that's launching that's going to do something very similar to that, but with more leverage, private product. But like basically, like I'm all in on that trade. Also, we raised a bunch of money to put that on in a private fund structure, and so like just so you know, like I think that when you look at spreads, they're at 25-year tights, and it's just a wildly asymmetric trade. And you just look around and you can see like, okay, things are okay, but like, let's just say there's a scenario where they do start cutting the deficit. And then let's just say rates do come down, like that's less money going around. And then, there's less, credibility, but more importantly, there's a huge amount of refi, because all that really matters in the financial system now, it's very different than the early days, is refinancing, right? Like almost all the times when we have crashes, it's because there's refinancing and there's not enough liquidity. And then there's because when you're in a 3 times levered 3 to 4 times levered world, there's clearly not enough dollars out there, right? Like, and so if everyone needs dollars at the same time, essentially it becomes a cash grab, and then it's a dollar bull, which means if your claims on dollars, which is debt and equities, they get re-rated down, and that's kind of the way I see things going. And at this time, which is different than the GFC, because the GFC, we dragged the world down, right? Like our ridiculous underwriting, and then the leverage on that underwriting, and then the leverage that banks use and using wholesale funding, then permeated to the rest of the world. Whereas this time, I think it's the rest of the world, because Europe's got a huge debt problem. And so like what I think really is going on is all the COVID debt that was issued is now coming to roost. It's about 4-year term average. Go ahead.
Yeah. No, I was just going to say that, Ben. You know, most of corporate America refinanced their debt in 2020 and 2021, and that was 3 to 5 year debt. So that was done at, let's call it 0% interest rates during COVID, and now everybody that refinances is going to be at a much higher rate, and that refinancing is going to start, this year in 25 and through 27. And it's going to be a real jump in their interest costs as part of the P&L.
So, Charlie, when you said that you think most of the credit risk lives outside the banking system, are you saying that it lives in the credit in the bond markets or the private credit markets or securitized debt markets? Like, where do you see the biggest credit risk?
On the consumer side, it would be in the monolines. So it would be the Ally Financials or the credit acceptances in the auto industry, or it'd be in the Bread Financial or the Synchronies in the credit card industry. But in the corporate market, it is private credit or private equity, or the BDCs that have taken on huge share. Mm-hmm. The banks this time around, this is the first time in my career that banks have actually managed their balance sheets very conservatively. And I think, while they may be taken down if we have a severe credit cycle, because portfolio managers will shoot first and ask questions later, I think they'll prove that they've managed their balance sheet risks much better this cycle, and they'll come out of that cycle with their capital intact. Whereas in the past 3 recessions or major credit cycles, they've been impaired their capital with credit risk, and they've had to spend the first 3 years of a recovery rebuilding their balance sheets. So I think
they won't have a balance sheet issue, although some of the more capital markets dependent ones may have an income statement issue because there's been a frenzy of activity that they've been involved with around securitizations and private equity.
An earnings issue rather than a balance sheet impairment issue.
Yeah.
If we have a downturn in the credit cycle.
Hey guys, we're kind of running long on the tooth. I appreciate your efforts. I'm Paul. He's Ben and Charlie. We have Verna. And of course, we have our quarterback behind the scenes, Ben Seelig. I tell you, I have done very well with the security selections of our 3 panelists today. So listen up, everybody. We'll see you tomorrow.
Thanks, Paul.
Thank you.
Thanks, Jen.
Thank you.